Hi and welcome to this Premier Trading revision video which will look at how to calculate the payback period for a capital investment. This is a subject which is almost certainly going to feature in your exam, so you need to be sure you fully understand how to calculate the payback period. The thing that differentiates a capital project from normal day-to-day expenditure for a business is that a capital project will involve spending money today in order to earn income in the future. It's expenditure on assets which the business will use over a period of years, such as property, machinery, vehicles and perhaps even acquisitions of other companies. If we spent money on a capital project today, we would have an initial cash outlay, shown here in red. We always refer to today as year zero, which means that 1 year from now will be year one, and so on. So, in year one, we can expect to have earned a positive cash flow as a result of owning the asset, shown here in green. More cash flows into the business in year two, year 3, year 4, and at year 5, the cash inflow to the organisation has fallen from that in the previous year. We'll assume for the purposes of this example that the asset has reached the end of its useful life at the end of year 5 and will be scrapped. The payback period is the period of time it takes for the initial cost of the capital investment to be repaid from net cash inflows, and is a quick and simple method of appraising different potential investments. Here's the project from earlier. We can see that the cash inflows at the end of year 2 have still not been enough to recover the initial outlay. However, when we add in the cash inflows for year 3, we will have recovered the amount spent. In fact, cash inflows now exceed the initial investment, and so the payback period, judging from the graph, must be somewhere between 2 and 3 years, around 2 years and 6 months. We'll look at how to calculate the exact payback period in years and months in a moment. When faced with a payback calculation, we need to list all the cash flows for each year, with any cash outflows being shown as a negative number. We also show the cumulative cash flow at each year. This is the difference between the total cash outflows and total cash inflows. We then need to identify the point at which the cumulative cash flow is zero. This will be the payback period itself. Here, a company has two alternative investment projects, Project Y and Project Z. Project Y involves an initial outlay of £20,000, shown here at year 0 as a negative value. The positive cash flows for subsequent years are then shown, £8,000 for year 1, £12,000 for year 2 and so on. The third column then shows the cumulative cash flows. Let's look more closely at Project Y. After 1 year, the cumulative or net cash flow is negative £12,000. This has been calculated as negative £20,000, the net cash flow for year 0, plus the £8,000 positive cash flow for year 1. After 2 years, the net cash flow is calculated as negative £12,000, the net cash flow for year 1, plus year 2's positive cash flow of £12,000, giving a cumulative cash flow at this point of 0. The payback period for Project Y is therefore exactly 2 years. The data for Project Z is also presented in the same way, but notice how the payback period is not realised until the end of the 3rd year. So, the respective payback periods are 2 years for Project Y and 3 years for Project Z. On this information alone, Project Y would be the preferred project, as it has the shorter payback period, meaning it's a less risky investment. As we saw earlier, payback periods don't always work out to a whole year, and you'll need to estimate the payback period in years and months. To do this, we'll need to assume that cash flows occur evenly throughout the year. In other words, if the cash flow for a year was £12,000, it assumes that this happens at exactly £1,000 every month. Of course, this is unrealistic for most businesses, but it's an assumption we need to make. Let's look at another example. Here, C Limited are looking at a potential investment that requires an initial outlay of £20,000. The cash flows in future years are £6,000 in year 1, £10,000 in year 2, £14,000 in year 3 and £8,000 in year 4. You should be able to see that after 2 years the positive cash flows would add up to £16,000, which is £4,000 short of the payback point. Therefore, we'll reach payback once another £4,000 has been earned. In the 3rd year we have a positive cash flow of £14,000, but we only need £4,000 to reach payback. We therefore need to determine how many months it will take to earn the £4,000 needed in year 3. If we divide £4,000 by £14,000 and then multiply this by 12 months, this will give us a figure of 3.42 months, which, when rounded to the next nearest whole month, tells us that it would take 4 months to earn the £4,000 required. The payback period would then be stated as 2 years and 4 months. Of course, this is only an approximation, but it's still a useful measure. Remember, you should always round the number of months up. If you rounded it down, the project wouldn't quite have reached the payback period by that point. The payback period is also a measure of safety. The shorter the payback period is, the less risky it is, as the initial outlay is recouped more quickly. Also, cash flows in the earlier years of a project will be easier to predict, whereas cash flows later in the life of a project may not actually occur as predicted. Therefore, predictions on the payback period are likely to be more accurate as it places a greater emphasis on these earlier cash flows. The payback period is particularly useful for projects which could quickly become obsolescent, perhaps because of changing technology, as it focuses on how quickly the company will get its money back. Using the payback period as a way of analysing possible capital projects has a number of advantages. In particular, it's easy to calculate and to understand, and focuses on risk. However, it's usually too simplistic to use on its own, and it ignores any cash flows which take place after the payback period, doesn't take into account the timings of cash flows or the time value of money. A more sophisticated way to look at these issues is to use discounted cash flows, which are looked at in another video. Payback calculations are common in the Level 3 costing exam, and you must be sure that you understand both the technique and the advantages and limitations of the payback period. Be particularly careful to make sure you're able to calculate the payback period to the nearest month, as this is a common task seen in the assessment. Hopefully this video will have helped you to understand this key topic a little better. Thanks for watching.